let's start. Like I mentioned, we have 2 more illustrations for us to be able to complete capital budgeting topic. So today we are going to complete it. Then we'll move to the next one in our next class. Okay. We need somebody. The other question is not on this material, but let's start with this. Once we are done with this material, with this question, then we'll move to, I will switch to the material where I have the question. The other question has to do with project specific NPV as well as the modified internal rate of return in a question. So, but first thing first, maybe I should even try that one. Okay, let's continue with this. Yes, I need one of you to read for us. Who will lead? Who will read for us? I need one of you to read. Yes, who is helping us? Yes. Nobody is willing to read. Maybe I should call.
Okay, yes, sir.
Okay, thank you, Omi.
Okay. Femi Appliances Limited is a Nigerian-based manufacturer of household appliances with many distribution centers across various locations in Nigeria and along the ECOWAS sub-region. FAL is now considering the development of a new motor vehicle vacuum cleaner, VC4. The product can be introduced quickly and has an expected life of 4 years change with a more efficient model. Costs associated with the product are estimated to be direct cost per unit. We have labor, 3.5 skilled labor hours at 500 naira per hour, 4 unskilled labor hours at 300 naira per hour. Materials, 6 kilos of material Z at 146 naira per kilo, 3 units of component P at 480 naira per unit, 1 unit of component Q at 640 naira. Other variable costs, 210 naira per unit. Indirect cost, apportionment of management salaries, 10,500,000 per year. Tax allowable depreciation of machinery, 21 million naira per year. Selling expenses, not including any salaries, 16,600,000 naira per year. Apportionment of head office costs, 5 million naira per year. Rental of buildings, 10 million naira per year. Annual interest charges, 10,400,000 naira. Other annual overheads, 7 million naira, including apportionment of building rates, 2 million naira. Note, rates are a local tax on property. If the new product is introduced, it will be manufactured in an existing factory and will have no effect on rates payable. The factory could be rented for 12 million naira per year, not including rates, to another company if the product is not introduced. New machinery costing 86 million naira will be required. The machinery is to be depreciated on a straight line basis over 4 years and has an expected salvage value of 2 million naira after 4 years. The machinery will be financed by a 4-year fixed rate bank loan at an interest rate of 12% per year. Additional working capital requirements may be ignored. The new product will require 2 additional managers to be recruited at an annual gross cost of 2.5 million naira each. And 1 manager currently costing 2 million naira will be moved from another factory, where he will be replaced by a deputy manager at a cost of 1.7 million naira per year. 70,000 kilos of material Z are already in inventory and are not required for another production. The realizable value of the material is 9,900,000 naira. FARM will use the existing advertising campaigns for its distribution centers to also advertise the new products. This will save approximately 5 million naira per year in advertising expenses. The price per unit of the product in the first year will be 11,000 naira, and demand is projected at 12,000, 17,500, 18,000, and 18,500 units a year, 1 to 4 respectively. The inflation rate is expected to be 5% per year, and prices will be increased in line with inflation. Wages and salary costs are expected to increase by 7% per year, and other costs, including rent, by 5% per year. No price or increased costs or cost increases are expected in the first year of production. Income tax is at the rate of 35% payable in the year the profit occurs. Assume that all sales and costs are on cash basis and occur at the end of the year, except for the initial purchase of machinery, which would take place immediately. No inventory will be held at the end of any year. Required. A. Calculate expected internal rate of return associated with the manufacture of VC4, showing all workings to the nearest million naira. B1. What is meant by an asset beta, and how is it different from equity beta? B2. If we are told the company's equity beta is 1.2, the market return is 15%, and the risk-free rate is 8%, discuss whether you would recommend introducing the products. C. The company is worried that the government might increase corporate tax rates. Advise the directors by how much that the tax rates would have to be changed before the project is not financially viable. A discount rate of 70% per year may be assumed for Part C.
Thank you very much, Wumi. That is the question. You can see is a very big one. And this is a kind of question that you have to be very careful before you put your pen to paper. Because on the day of your exam, when you are faced with this kind of a question, of course, anxiety and the pressure of the moment can even make you to forget what you know. All right. So you have to be very careful. You take a very deep breath before you begin to solve the question. All right. So as you can see, based on what Wumin has read so far, you will notice that this question is related to performance management, such that if you don't have deep understanding of relevant costing in performance management, you may struggle to solve the question correctly. So you must be able to identify which of the figures given to you are relevant, which one are not relevant. All right. So yes. Now, before you can do well in this kind of a question, the first thing first you need to do is to bring out all the relevant variables that you need. All right. You bring out all the relevant variables that you need to do justice to the question. You don't need to be in a rush. After you have digested the question, examiner is asking you to compute internal rate of return. Ordinarily, internal rate of return is very simple and straightforward to compute, but everything has been scattered in this question. So you need to first of all bring out all the variables that you need. You know that whenever you want to appraise or you want to determine the financial viability of a project, you need relevant cash flow. You need appropriate cost of capital. You also need the useful life of the project. So you need to go into the question to identify the relevant cash flows. The appropriate cost of capital has been given to you in the question, so no issue. The useful life has also been given to you in the question, which means that where you have battle, okay, the battle that you want to face now is your ability to be able to identify relevant cash flows. So let's go there one by one. All right. Now, one unique thing about this question is that examiner did not give you the price that you are expected to. You are only given you are given the information that will enable you to compute the direct cost. Okay. But the cost for each year you are not given, whether the cash flow given to you is in current value terms or in year one prices. But there is a cliff in the question. In the first paragraph, examiner did not mention that, but there is a clue in the question after the inflation. Examiner told you that in the last paragraph, you are told that, second to the last paragraph, you are told that no price or cost increase are expected in the first year of production, which means that year one, the cost year one cash flow is the first year price. And that's what the examiner is telling you, that you should not inflate from year one. You have to start inflation from year two. Okay? However, even if you don't consider that information, if you don't consider this information as given to you, how will you know whether this is a first year price, current value term, year zero prices, or year one prices? How would you know? Let's say if examiner is silent, that means you are going to assume they are in first year price. All right. But if examiner wants you to do something, they will surely tell you that it's in current value terms or in today's prices, or the examiner may tell you that now selling price now is 1,000 naira. Because the examiner has mentioned now, it means it's a real cash flow. Then you have to start inflating from year one. Okay. But in this particular question, examiner did not tell us that, apart from this clause where you are told that the price or cost increases are expected in the first year. Sorry, no price or cost increases are expected in the first year of production. So which means that you need to start the increase, you need to start applying inflation right from year two. Okay, so you must watch out. You must watch out. So I will stop sharing this. At your end, you can open to the material, but here I will stop sharing and move to the working notes so that quickly within the next 1 hour, we should be able to complete this. All right. Okay. So this is solution to illustration number, what is that? Number 7. Solution to illustration 7. That's a page 40 what? Page 49. Okay. All right. The name of the company is Femi Appliances. Femi Appliances Limited. Okay. So examiner wants you to calculate internal rate of return. There is no way you can't just go ahead and be solving and be calculating internal rate of return without even knowing the first year price. So the strategy if you are faced with this kind of a question, the strategy you are expected to adopt is that you bring out the first year price first across board, starting from the way the scenario is you begin to do your workings. After you are done with your working, then all you need to do is to be posting it. So that's the approach we are going to adopt. However, on the day of your exam, when you are faced with this kind of a question, you need to estimate how many pages will be sufficient for you to solve requirement number A. How many pages do you need to solve requirement number B and C? All right. So you need to estimate that. Give and take. You can't spend more than 4 pages. Okay. You can estimate 4 pages. Then you start from the 5th page, your workings. All right. But it is not appropriate to start from the first page to have your workings on the first page. So you need to avoid that. Presentation is also very key, especially at this level. However, for the purpose of this class, let's begin to solve it. Then, of course.
One second, Mr. Adejuwon, if you don't mind. I know that there's no time. So what I want to appeal for is after you have finished solving the question, maybe you can run through that current now price, current year, because this whole question, if somebody misses that first part, the whole solution will collapse. Just this, how to recognize that current price, current cost, and etc., can collapse a whole 1 hour question if you don't get that first part right. So
Yeah,
if there's time
yeah.
after you are done, we can revise it if you don't mind, please.
No, no worry. I will mention it. As we are solving, I will mention. No worries. All right. Now, so let's open to your material. Let's go through it together. Now, examiner has given to you direct cost per unit. That direct cost, you are told the first item there is labor. You are told that 3.5 skilled labor hours at 500 naira per hour. You also have 4 unskilled labor hours at 300 naira per hour. Now, the issue is that all these prices given to examiner, this is not the price you are supposed to use. This is just an information for you to be able to calculate labor cost per unit, material cost, material Z per unit. Okay, material P, component P, component Q. These are not the main. Some of them are not the main price. So you are given the information, so you are supposed to do the right thing. But the bottom line, this is what I'm trying to explain. In this question, examiner did not give you the first year price or current. You are not told whether it is in current value terms or in first year prices. What I mentioned, you recall that when I was explaining the concepts under general rules for inflation, I mentioned to you specifically that when prices are stated, when cash flow is stated in year 1 prices or first year prices, inflation should start from year 2. That is, you don't inflate the year 1 price because the year 1 price is the base year price. All right. Then B part of that note that I told you previously was that if you are told that if cash flow as stated in today's prices, year 0 prices or current value terms, inflation should start from year 1. Okay. Now, in this particular question, examiner did not tell you whether it is in first year price or is in today's prices on current value terms. But there is a clue in the question in the second to the last paragraph after the inflation rate. Examiner mentioned to you that no price or cost increases are expected in the first year of production, meaning that you need to first of all determine your first year price, because since there is no price increase in the first year of production, it means that you must determine the first year cost or the first year selling price. Okay, so if that is the case, you don't inflate the first year price. Rather, you only need to start inflating from year 2. All right, you start inflating for year 2 because you have been given, even though the first year price is not given to you, but examiner has told you that there is no price increase expected in the first year of production. So we need to first of all determine the first year price. Once we have the first year price, then you now increase it. You start increasing from year 2 by applying the inflation rate. So if that is the case, then in this in my own calculation now, pardon?
No, I said that is clear. That is okay. It's clear.
All right.
At least
so,
for me, yeah.
Yeah. So all we need to do now is to start our working. But remember what I told you on the day of your exam. Don't start with working on your main solution. You need to estimate how many pages will be sufficient for you to answer the 3 requirements. All right. You can't start with your workings. That's not appropriate. You can't start with your workings. So you need to start from you need to estimate the pages that will be sufficient to satisfy the requirement. Okay. However, based on what we are doing currently, of course, we are going to start with the workings so that we don't need to be flipping from one page to another. All right. So that will also save our time. So workings. So working number 1. Examiner has told you that direct cost per unit. So the first item there is labor. So let's determine labor cost per unit for the first year. All right. What's the labor cost per unit? There are 2 categories of labor. we have skilled labor and then unskilled labor. So quickly, so you then come here labor cost. We want to determine labor cost. So under labor cost, we have skilled labor equal to, we are told that 3.5 skilled labor, 3.5 hours multiplied by how many? What's the cost per hour? 500 naira per hour. Okay, so multiply by 500 naira. So what do you have there? Bring out your calculator, please.
1,750.
1,750. Then we also have unskilled labor. For the unskilled labor, you are told that 4 unskilled labor hours are 300 naira per hour. So 4 multiplied by 3, 4 hours multiplied by 300 naira, which is equal to 1,200. So when you add the two together, that will be 2,950. So this represents the labor hour per unit. This is the total labor cost per unit. So if that is the case, we need to determine the total labor cost for the relevant years. So I will then come here. The useful life of the project is 4 years. Okay, and we are told that tax is paid in the year profit is made. So if that is the case, I have year 1. Okay, let me give more space. Year 1, year 2, year 3, then year 4. We want to inflate the labor cost. So labor cost, examiner told you in the question that all relevant cash flows, all the variables that made up the project is being inflated at 5%, except labor, except wages and salary, which is 7%. So anything that has to do with wages and salary, you need to inflate it by 7%. Every other cash flow will be inflated at 5%. So if that is the case, I will say labor costs at 7% per unit. Okay, 7% rather. Then the first year price is 2,950. Examiner has told you that no cost or price increase are expected in the first year of production. So this is the first year price, 2,950. So we are not expected to increase that in the first year. Therefore, as you are moving to year 2, you want to inflate. You then say the inflation rate is 7%. So you say 1.07, 1.07 multiplied by 2,950. Okay, that's 3,157. You approximate it, 3,157. Here is 3,157. So what you have in your calculator, multiply by 1.07, multiply by 1.07 equal. That's
3,377.
3377. So what you have in your calculator multiplied by 1.07.
3614.
3614. So with this, we have inflated the labor cost. You will see that we did not inflate the first year price. So because once you are given the first year price, you should start inflating from year 2. The fact that you are inflating from year 2 does not mean that you are now going to put raised to power 2. No. For example, if I want to use primary school method to be doing this is the best method that you can use on the day of your exam. It's faster. If I want to use primary school method, I will just come here, labor cost, 2,950, 2,950, 2,950. This is a waste of time, 2,950. I would then say inflation at 7%. Then 1.07, 1.07, 1.07, 1.07. Okay, this is what I will, if I want to use primary school method, this is what I will do. It's a waste of time. You are still doing this, I've moved to the next one. So if I now want, of course, anything raised to power 0 is equal to 1. So this one will remain 2,950. Then the second one, I would then say 1.07, okay? 1.07 raised to power 1 equal, they multiply by 2,950 equal, that's 3,157, okay? Then I will say also 1.07 raised to power 2. Sorry, I did not clean that. 1.07 raised to power 2 equal, that's 1.1 whatever, multiplied by 2,950. Okay, that gave me 3,377. So you continue to do it like that. So this is what you are going to do if you want to use primary school. If this one is more convenient for you, but use it, but it's a waste of time. I just use this one as an example. All right. So let's move on. All right. Now, since we have gotten the labor cost for the respective years, so you need to multiply with number of units. So we then go back to the question, what's the unit for the first year? According to the question, what's number of units for the first year? Yes.
12,000.
12,000 units. So here is 12,000, 17,500, 18,000, 18,500. I think am I correct? Let me confirm.
Yes.
Oh, okay. Thank you. So let's move on. So all you need to do now is to multiply. Multiply. Our figures will be in millions. So total labor cost in millions. Okay, yeah, multiply. What do you get? Two 950 multiplied by 12,000. That's 35,400,000. So that's 35 rounding. 35. Then the second year will be 3,157 multiplied by 17,500 equal. That's 55. The third year is 3,377. Sorry. 3,377 multiplied by 18,000. That's 61.
61.
The fourth year is 3,614 multiplied by 18,500. That's 67. So with this, I'm done with labor costs. I've inflated labor costs. All I need to do is to go and post, but you can't post anything now. Let's complete all our workings. So we move to the second one, second working. So we go back to the question from the information given to us. After labor, the next item is material. You are told that 6 kilos of material Z at 146 naira per kilo. So which means that material Z is in kilo, not in units. Material Z is in kilo. So you need to convert unit to kilo. All right. You are told that 6 kilo of material Z at 146 naira per kilo. So let's go and do working for that. Material Z. So you then say material Z okay. Year 1, year 2, year 3, and year 4. Material at inflation rate of 5%. The first year price given to us is 146 naira. Therefore, 146 multiplied by 1.05. 146 multiplied by 1.05 equal to 153. Here is 153. So what you have on your calculator, multiply by 1.05. That's 161. Okay. Then multiply by 1.0. 169. So this is the price for material Z. This is the price for material Z. So at this point, all I need to do now is to determine, I need to get my kilo. Okay, I need to get the I need to multiply it with number of kilos. So I would then say actual kilo needed. Examiner told us in the question that they have some items of material Z in the inventory. So we need to go and do the workings. So I will then get the total. Let me see. Let me push it down. So we need to do working for the actual kilo needed. Actual kilo needed for year 1, year 2, year 3, then year 4. So to get the actual kilo needed, you are going to multiply the units, which is 12,000, 17,500, 18,000, then 18,500. So you multiply with the kilo. We have 6 kilo. We are given 6 kilo per unit. All right, 6 kilos per unit. So let's get the total kilo. Total kilo. So multiply for me, please.
72,000 for the first.
12,000 multiplied by 6, 72,000.
72.
Okay. Next one.
105,000.
105,000. Next.
108,000.
108,000. And the last one.
111,000.
Okay. So these are the total kilos needed. All right. Total kilos of material Z needed for production. However, examiner told you in the question that they have 70,000 kilos of material Z in the inventory. So let's go to the question. If you go to the paragraph 1, 2, 3, 4, the fourth paragraph, the fourth to the last paragraph, where you have information on information on deputy manager and all of that. So examiner told you that 70,000 kilos of material Z are already in the inventory and are not required for other production. Remember, in your performance management, there are two categories. Two things can happen to the material you have in the inventory. All right. The material can be in the inventory. The material can be out of stock. If the material is in stock and in frequent use and will be replaced, we said the relevant cost is the current purchase price. Now, this material, you have it in stock. Examiner told us that material Z is in stock. Okay, they already have it in the inventory. So which means that the company will not incur any cost on that 70,000 kilos of material Z. They are not going to incur any cost on it because it's already in the inventory. It is only, remember, relevant cash flow must relate to the future. Before you can recognize as a relevant cost, it must relate to the future. So any cost of material you have in your inventory are past cost, they are sunk cost and therefore irrelevant. So the cost of these 70,000 kilos of material Z that are already in the inventory, the company has already purchased it and that's why they have it in the inventory. It's not relevant to the project at all. Even if the company is going to use it for the project, for the fact that they have already purchased it previously is irrelevant. You ignore it. Christy, please mute. Okay, so what are you supposed to do? You need 72,000 kilos of material Z and you have 70,000 kilos in the inventory. What will you do? Just less the 70 from the 72. That means you only need to buy 2,000 kilos. So I will then go back there. Available kilos. Kilos in inventory. 70,000. Less. Therefore, the actual kilo needed in year 1 is 2,000, 105, 108, then 111,000. This is the actual kilo needed for production. So I would then come here, multiply by 2,000, multiply by 105, 108, then 111,000. So multiply everything together. What do you have year one? 146 multiplied by 2,000. Okay. 146,
292,000.
292,000. Okay. Here is 19. Here is 19 million. So 292,000. Remember, our figures are in millions. So total, our figures are in millions. So 292,000 divided by 1 million, that will give you 0.3 million. Okay. So rounding our number to 0.3. 292 is what is rounded to 0.3. So please watch out. Then for year three, year two, what do you have there for year two? Yeah.
16.1.
Pardon?
16.1.
For year two is 16. Okay, here will be 16. Year three,
17.
17. So with this, we are done. We are done with material Z. But there's one additional information relating to material Z in that same paragraph. Examiner told you that the realizable value of the material is 9.9 million. We're still on that same paragraph where you have 70,000 kilos of material Z. So examiner told you that the cost of the 70,000 kilos of material Z, if they want to sell it now, if they want to sell it, the company will realize 9.9 million naira. But will the company be able to sell it? Because they want to use it for this project, they won't be able to sell it. They will not be able to sell that material. Therefore, that 9.9 million naira, what do we call it?
Opportunity cost.
Opportunity cost. That's opportunity cost. Benefit forgone as a result of taking a course of action. So that 9.9 million naira is an opportunity cost, which should be part of the this project. Because if not because of this project, the company would have disposed of the material and realized the 9.9, but they cannot realize it because they want to use that 70,000 kilos for the project. Therefore, it should be part of the cost of the project. So you then come here. If you like, you can do it as a separate line item. If you like, you can just come in and say opportunity cost, or just say net realizable value. Net realizable value, or you call it opportunity cost on material Z. So the first year is 9.9. So here is 9.9 dash. Add everything together. Here is 19, 17, 16. This is 10.2. Round it up. Our figures are rounded. Examiner say we should round our number. Okay, so you round your number to whole number. That's 10 million. Okay, so this is what you are going to recognize. This is the total you recognize. All right. Of course, figures are in million. So that's for material Z. The number 3, move on. The next, working with MB, that's we also told there are 3 units of component P at 480 naira. So let's do for component P. Working number 3, component P. So under component P, examiner told us that 3 units of component P at 480. Therefore, I will just say equal to 3 units multiplied by 480 naira. So what do we have there? 3 multiplied by 480, what do you have?
1,440.
1,440. That's the cost for year 1. That's the cost of my component P in year 1. So in this case, we need to multiply with number of units. Component P is in units. Therefore, I would then say year 1, year 2, year 3, year 4. Let's move faster. Let's move faster. So Component P, inflation rate is 5%. So the first year price is 1,440. Therefore, 1.05 multiplied by 1,440. What you get?
1512.
1512 multiplied by 1.05.
1588.
1588 multiplied by 1.05.
1667.
1667. So that's that. Then multiply with number of units. Unit for the first year is 12,000, 17,500, 18,000, 18,500. So add everything to multiply. Multiply total in millions. Okay. Yeah.
17.
17 for the first year.
26.
26.
28.
28.
29.
29. So we are done with material component P. So then move to the next one, component Q, number 4 workings. Component Q.
No, sir, year 3 is
No,
29. Year 4
Year
is
three.
31.
31.
Year 3, 29. Year
Okay.
4, 31.
31. All right. Thank you. So move on from there. Then component Q for year 1, year 2, year 3, then year 4. Okay. So components Q at inflation of 5%. No, before that, we need to compute the component Q. Okay, we need to compute component Q. So let's go back to the question. How much is component Q? You are told that 1 unit of component Q at 640. So that means I don't need to waste my time. I will just say at 640. Component Q at 640. 640 naira. So I will do for year 1, year 2, year 3, then year 4. Components Q at 5%. The first year price is 640. So 640 multiplied by 1.05. What you get?
672.
672. Multiplied by 1.05.
706.
Multiplied by 1.05.
741.
741. So you multiply with number of units. The first year is 12,000, 17,500, 18,000, then 18,500. So let's multiply. Yeah.
Year 6, 14.
Yeah.
Year 4.
Year 4.
Year 4.
14 million. Okay.
Year 1, 8.
8.
Year
Year
2,
3,
12.
13.
Year 3, 13. Year 2 is
12.
12. Okay, so we are done with that. Move to the next one. Okay. Then we also have other variable costs, 210 naira per unit. Other variable costs, 210 naira per unit. Okay. So other number 5. Other variable costs. OVC. OVC is equal to, we are told it's 210 naira per unit. Okay. So I will do for year 1, year 2, year 3, then year 4. OVC at 5% inflation. First year price is 210. 210 multiplied by 1.05. What you get?
221.
221.
221 multiplied by 1.05.
232.
232.
Multiplied by 1.05.
243.
243.
Okay, so that's multiplied with number of units. Multiply by 12,000, 17,500, 18,000, then 18,500. Let's multiply.
Year
What you
one,
get?
3.
Yeah. Year one is 3 million. Okay. Next.
Year 2, 4.
Year two is 4.
Year
Year
3, 4.
three.
It's also 4.
Year 3 is 4.
Year 4
Year
is also 4.
Yeah,
4,
4
4.
is 4.
Okay. Okay. So that's that. Move to the next one. The next item is indirect cost. Pay attention to this. Indirect cost. Under indirect cost, apportionment of management salary 10.5 million naira per year. I need you to tell me that 10.5 million naira relevant or irrelevant? Yes. If you know it, let me.
Relevant.
Pardon?
Irrelevant.
Relevant or irrelevant?
Irrelevant.
Irrelevant.
Why is it not relevant?
Because without the
The salaries
project,
will be
they'll
paid
still
anyway.
pay
They are apportionate.
management salaries.
No. We are not in. We are not in the zoo. You raise your hand if you know it. We want to learn together. If everybody is talking at the same time, we will not get it. Yes, Mr. Roberts, what are you saying? Talk to me.
No, I'm saying that is irrelevant because the
Why?
management salaries, they will still incur that management salary, whether they are without this product. So that is why it's irrelevant. It's an allocated
Okay.
cost. So the cost is already given.
Yeah. So irrespective, thank you. Irrespective of the decision taken on this project, salary must be paid, isn't it? So provided your fixed cost will not change, therefore it is irrelevant. However, one thing is very clear in this line item. Anything that has to do with apportionment is irrelevant. When you see apportionment, please ignore it. It is not relevant. Apportionment is not an actual cost. Apportionment are kind of the cost incurred that will now be distributed to different units or different departments or different projects. So it's not an attributable cost. So when you see apportionment in a question, please always ignore it. It's irrelevant. I believe that is clear. So this 10.5 million naira, so just ignore it. It's not relevant. Move to the next item. Tax allowable depreciation of machinery, 21 million naira per year. Of course, examiner is just giving you the capital allowance for each year. So when we get there, we'll talk about that. Next item, selling expenses, not including any salary, 16.6 million naira per year. Selling expenses, 16.6, relevant or irrelevant? If you know it, raise your hand, please, quickly. Selling expenses, relevant or irrelevant?
It looks relevant because it's specific to the product. If the selling expenses is specific to the product, it's relevant.
Okay. All right. It's true. Any selling expenses, whether it is fixed or variable, are relevant because if you don't incur the selling expenses, you won't be able to generate sales. All right. So that's good. All right then. So 16.6 million. Two things can happen. If I like, I can do working for this. If I like, I can ignore it so that when I'm computing my NPV, I'll just say selling expenses since it's not related to unit. But on the day of your exam, in order not to forget, it's better for you to just put it down as part of your workings. So you can say selling expenses. Selling expenses at 16.7 million. 16.6 million per annum. So you do for year 1, year 2, year 3, then year 4. So selling expenses at inflation rate of 5%. Look up, everybody, and pay attention, please. Pay attention. Now, the selling expenses given to us is 16,600,000. When you want to inflate, remember our number are in whole number. So I'm going to, in the first year will be 17 million because the 16.6 million naira will be rounded up to 17 million. But in my calculator, when I want to inflate for the second year, I will just say 16.6 multiplied by 1.05. This will give me 17. What I have in my calculator multiplied by 1.05. Okay, multiply by 1.05. This is 18. Then for the fourth year,
19.
what I have in my calculator multiplied by 1.05 equal to 19. So that's what you need to do with this. I've inflated the selling price. That's what I'm going to recognize when I'm computing my NPV. Okay, so let's move to the next item. Yes, the next item is apportionment of head office costs. I just mentioned that anything that has to do with apportionments, they are irrelevant. Therefore, just ignore it. Okay? Rental of buildings, 10 million naira per year. Whether you rent the building or not, of course, whether you execute this project or not, you must rent your building now, isn't it? So rental of building is not directly attributable to the project, so you ignore it. Examiner even told you in the question that there's a place they mentioned rents.
The factory could be rented for 12 million.
Yeah, no, that I was
So-
even saying there's a
So
particular
there's a
place
part
they
that is
mention.
relevant to.
No, there's a place they mention rents, but when I get that, I will
It's the
comment
first
it.
paragraph.
If the
You said the
new
factory could be rented for 12
no,
million.
I know, I saw that one. I saw that one. No, let's move on. So the 10 million naira per year for the rental of the building is irrelevant. Ignore. Then annual interest charges 10.4 million. 10.4 million. Relevant or irrelevant, please? 10.4 million. Annual interest
That is
charge.
irrelevant. I think you explained that cost of capital has already covered this.
You are correct. So when you are given absolute amount of interest, please ignore it. It is not relevant. Any interest amounts, any amount of interest given to you are generally irrelevant. Why? Because the cost of capital to be used for the to be used to discount the cash flow already included interest. So if you now consider the absolute amount of the interest, like in this case now 4.4 million, sorry, 10.4 million naira. If you consider it as part of the cost of the project, that means you are treating interest twice. So whenever you see absolute amount of interest in a question, ignore. It is not relevant. Number next, other annual overhead, 7 million naira, including apportionment of building rates, 2 million. Of course, what you are supposed to do, the 7 million is not relevant. The 2 million naira is also not relevant. However, since examiner has told you that other annual overhead, you are given the portion that relates to apportionment, which is 2 million. So all you need to do is to say 7 million minus 2 million. The balance of 5 million naira is relevant. So I will then come here, other annual overhead. Number 7, working number 7, other annual overhead, which is equal to, okay, let me move to the next line. Other annual overhead, OAO. OHO is equal to 7 million minus 2 million equal to 5 million naira per annum. So only 5 million naira is relevant. So you then inflate this year 1, year 2, year 3, then year 4. OHO at 5%. The first year price is 5 million. Therefore, 5 million multiplied by 1.05. 5 multiplied by 1.05 equal to 5.
5.
5.
So then what you have in your calculator multiplied by 1.05.
6.
6.
That's 6. What you have in your calculator multiplied by 1.05.
6.
6.
6. So that's it. That's it. That's what we are going to recognize in our NPV calculation. Okay? Of course, figures are in millions. I don't need to put it to the other side again to just be repeating the same thing. Then number 8. We are getting there little by little. Number 8. Yes, if the new product is introduced, it will be manufactured in an existing factory and we have no effect on rates payable. The factory could be rented for 12 million naira per year, not including rate to another company if the product is not introduced. This 12 million naira, relevant or irrelevant?
Relevant.
Why?
Cost.
Pardon?
It's another
Revenue being
opportunity cost.
given. Yeah.
Is an opportunity cost. Yes, you got it. It's an opportunity cost. So I would then come here. You can say opportunity cost on rents, or you just say rents, opportunity cost, which is equal to 12 million naira per annum. So you can inflate this for year 1, year 2, year 3, then year 4. Rents at 5%. The first year price is 12 million. 12 million multiplied by 1.05. What you get?
13, 14.
Okay, 13, 13, 14. Thank you. So I'm done with that. Okay. Then I move to number 9, working number 9. Let's go back to the question. Yes. New machinery costing 86 million naira will be required. That 86 million naira is initial outlay. So we're coming back to that. The machinery is to be depreciated on a straight line basis over 4 years and has an expected salvage value of 2 million naira after year 4. After 4 years. Okay. So the machinery will be financed by a 4-year fixed rates bank loan at an interest rate of 12% per year. Okay. Additional working capital requirement may be ignored. So if that is the case, examiner has already given you capital allowance in the question to be 21 million naira, isn't it? You are told that tax and liable depreciation. Tax and liable depreciation is the same thing as capital allowance. Examiner has given it to you as 21 million naira. Now, how did they arrive at that 21 million naira? If you want to calculate the capital allowance, in fact, let's just do it once and for all. Let's calculate tax saved on capital allowance. Tax saved on capital allowance. Okay. Now, first thing first, because examiner has told us that our capital allowance is on a straight line basis. All right, our capital allowance is on a straight line basis. So I don't need to waste my time to be using the table I gave to you when I was explaining the concept. So I will just say I will use this format. Capital allowance is calculated as the cost minus scrap value divided by
By 4.
useful life. This can only work if it's on a straight line basis. If your capital allowance is on a straight line basis, like in this question, so it's on a straight line basis. So the cost of the project is 86 million minus scrap value. How much is scrap value? 2 million naira.
2 million.
Then divided by 4 years. Okay, so this will give us 21 million naira. This is how they arrive at the 21 million naira per annum for your tax allowable depreciation. All right, so this is how they arrive at that. So now that you know your capital allowance to be 21 million naira per annum, then you need to calculate tax saved on capital allowance. Tax saved. So tax saved on capital allowance is computed as the capital allowance multiplied by company tax rates. So which is 21 million multiplied by, according to the question,
35%.
what's the company tax rates?
35%.
35%. So multiply by 35%. So what do you get? That should be
7.335.
0.35. Remember, our figures, sorry, I'm putting percentage. Remember, our figures are rounded to million. So here will be equal to 7 million naira, approximately 7 million naira per annum. So that's our tax saved on capital allowance. I believe it's clear now. Now, move to the next one. Working number 10. So we're done with that paragraph. The new products will require 2 additional managers to be recruited at an annual gross cost of 2.5 million naira each. So let's calculate additional labor cost. Working number 10. Working number 10, additional labor cost. Okay. So you are now told that 2 additional managers will be recruited. The new product will require 2 additional managers to be recruited. So let's put it down at 2.5 million naira each. So 2 additional, just say 2 managers. So equal to 2 multiplied by 2,500,000 multiplied by 2,500,000, 2.5. This is equal to 5 million. Okay, our figures are in million. Then you are now told further that and 1 manager currently costing 2 million naira will be moved from another factory where it will be replaced by a deputy manager at a cost of 1.7 million naira per annum. So how do we treat that information? You have a manager that currently costs 2 million naira. This manager will be replaced by a deputy manager at a cost of 1.7 million. 2 million, 1.7. What do we do with it? Yes?
We ignore. Is a committed cost.
Which one?
The boots.
Both of them. Okay. Yes. Any other opinion?
Yes, sir. We ignore the 2 million. Why the 1.7 is relevant?
Why?
Because the 2 million will be incurred whether the new project is executed or not. Why the 1.7 will only be incurred if the new project is executed.
Okay, so you are correct. The 2 million naira is irrelevant. Like he mentioned, whether you execute this project, you are told 1 manager currently costing 2 million naira will be moved. So whether you execute this project or not, you must pay that 2 million naira. But you want to replace, you are replacing the manager that earned 2 million naira. You want to replace it with a deputy manager that cost 1.7. So if not because of this project, you are not going to incur that 1.7 because it's a replacement cost. And replacement cost is relevant, so you have to account for the 1.7. So I would then say deputy manager, 1 deputy manager equal to, this is 1 multiplied by 1.7 equal to 1.7. When you add the two together, that's 6.7 million. So approximately, that would be additional labor cost would be approximately 7 million. Okay, so you then come here, year 1, year 2, year 3, year 4. Remember, this relates to labor, and labor inflation rate on labor is at 7%. So you have to be very careful because you have been using 5% since. So if care is not taken, you just apply 5%, knowing that labor wage and salary is inflated by 7%. So you have to be careful. Additional labor cost. Labor cost at 7%. The first year price is 7 million. Because 6.7, when you round it, it will be 7 million. However, as you are moving to year 2, you are starting from 6.7. So 6.7 multiplied by 1.07 equal, that's 7 million. What do you have in your calculator?
788.
788
89.
multiplied by 1.07, that's 8. Multiplied by 1.07, that would be 9. Okay. So I'm done with that. 7789. So that's that. Then move to number 11. Let's go back to the question. God forbid, you solve all the workings and the examiner, if you later just tell you that a few minutes more, you can yeah, that vigilator no go gree, you go scatter everything.
Where are we getting 9 from?
9.
Yeah, 4. Where are we getting 9 from? It's 8.2.
No, it's 9. I've done the work.
8.56.
You are using 6.
Yeah, I'm using 6.7.
Yeah. So multiply by 1.05, which will give you, okay, let me do it from here. Multiply by 1.07. That's 8.2 multiplied by 1.07. 8.78. That's approximately 9.
I give up. Yeah, it's 9.
Yeah. So, yes, the last paragraph there. No, second to the last paragraph. We need to, before then. So you are now told that FAL will use the existing advertising campaign for its distribution center to also advertise the new product. This will save approximately 5 million naira per year in advertising expenses. So that 5 million naira for advertising expense, relevant or irrelevant? Yes. Relevant or irrelevant? 5 million naira.
Irrelevant.
Relevant.
Why?
It's a cost saving.
It's a cost because you are using the existing advertising campaign to run the advert for this. You are not incurring the cost. Therefore, that 5 million naira, you ignore it, it's not relevant. Then the next one, the price per unit of the product in the first year will be 11,000 naira. Okay, so that's selling price. So let's calculate selling price. Working number 11. Selling price. Okay. That's 11,000. Okay. So year 1, year 2, year 3, and year 4. Selling price at 5% inflation. The first year price is 11,000. 11,000 multiplied by 1.05. What do you have?
11,550.
11,550 multiplied by 1.05.
12,127. 12,128.
Multiplied by 1.05.
12734.
1, 2, 7, 3, 4. Then you now multiply with number of units. 12,000, 17,500, 18,000, then 18,500. So multiply, please. Yeah,
132.
132. Yeah,
202.
202.
218.
218.
236.
236. So that's that. So we have completed all our relevant workings. So at this point, all we need to do is now begin to solve the question. So you want to calculate internal rate of return. Now, because you have different kinds of variable in this question, I will advise you, of course, what you are supposed to do is to you can first of all determine your net cash flow. So, once you have your net cash flow, you can use any technique to appraise the project. Or if you don't want to follow that route, you can just, after your net cash flow, you can use assume your discount rate for your IRR, and then you move on from there. But I will advise you, because you have so many multiple variables, so it's important that you calculate your net cash flow first. So that will make life easier for you. Okay? So that you don't make mistake. Let me see, can this one accommodate? Let me just go to the new page. All right. So I would then say calculating net cash flow. Let's calculate net cash flow first. NCF. So our figures are in millions. Starting from year 0, year 1, year 2, year 3, year 4. Then you create a column for workings. All right. Now, because of the nature of this question, you have so many costs relating to the question, and you have only one line item for your sales. So if I were you, what I will do is I will add up all relevant costs together, because instead of you to be putting brackets on your cost all the time, it will waste your time. So I'm not going to start from sales value. I will start from all the way I've done my workings. So the first item is the labor cost. So what's the labor cost for the first year? Please be giving me the number. Based on our workings, labor cost for the first year is 35, 55, 61, 67. Okay. So here is 35, 55, 61, then 67. That's working number 1. Then the second working we did was the material Z.
10,
10,
16,
16,
17,
17, and then
19.
19. That's working number 2. Then we did component P. Component P in year 1 is what?
17,
17,
26,
26,
29,
29,
31.
31,
and 31. That's working number 3. Then we did component Q.
8,
8,
12,
12,
13,
13,
14,
and then 14. Working number 4. All right. Then We also did other variable costs. Other variable costs for year 1.
3,
3,
4, 4,
4,
4, 4,
4,
4.
4, 4. That's working number 5. Then after that, after other variable costs, what else? I think we also have selling expenses. Thank you. Selling expenses for the first year is 17, 18, 19. That's working number 6. After selling expenses, what's next?
Annual overhead.
Other annual overhead. In the first year is how much?
5566.
5566. That's working number 7. Next item.
additional labor cost.
Additional labor cost. So the first year is 7, then 7,
7, 8, 9.
8, 9. That's working number 8.
10.
Okay. Then
Number
after
10.
number 10.
Working number 10.
Okay. So additional labor cost working number 10, right?
Yeah.
Okay. So what's working number 8 and 9? Working number 8 is okay. Is
Rent, opportunity cost.
so we missed that one. Opportunity cost. That's number 8. Opportunity cost. Let's push this one down.
Okay, are we
Additional.
expected to bring those ones into?
Yes, now it's part of the cost. Additional labor cost. Here is 7, 7, 8, 9. Working number 10. This is working number 8. Working number 8 is opportunity cost on rents. So the first year is what? 12
12,
million.
13, 13,
And then
14.
14. Okay. So after additional labor costs, what else? I think that's all. Selling, no, not selling price. In fact, this selling price supposed to be sales. Our focus is on not selling price. Supposed to be sales. We write it as sales. All right. Okay. Then we've already considered additional labor costs. So that's it. Add up everything together, please. Add everything together. So total costs. Total relevant costs. Add it up year by year. Add it up year by year.
Year 4, 183.
183. Yep.
Year 1,
Yeah.
115.
Pardon?
Year 1, 115.
115.
150.
Year
Year
2,
2, 169.
155.
Year 2 is 155. Year 3 is what?
169.
169. So that represents the total cost. So you need to less that from sales. Sales is 132. 132. 202. 2. Is it 269? 218, 236. 218, then 236. This is working number 11. Okay, so find the difference between the two. This will
47
represent
for year 2.
47 for year 2.
Year 6, 53.
Year 4,
Year 4, 53.
53. Okay,
Year 3, 49.
49.
That's year 1
Year
total
1,
cost of
17.
Year 1 is what? 17.
17.
Okay, so this represents profits. After profits, you are supposed to pay tax. Tax is at 35% and is paid in the current year. So what's 35% of 17?
Mr. That total for year 1 is 114.
114.
Exactly, is 114.
Okay. 114. All right. So that means this is 18, right?
Yes.
Yes.
So multiply 35% of 18. What do you have?
6.
6. 35% of 47.
16.
16. 35% of 49.
17.
17.
17.
17. Then the last one,
19.
19. So you
19.
less, of course, put it in brackets. Then you consider tax saved. Remember, we have a format. So tax saved on capital allowance, this company will claim 7 million naira per annum. This is working number 9. Okay, that's working number 9. Then we consider scrap value. We are told that scrap value is 2 million naira per annum. Sorry, for the final year, 2 million. Then we consider initial outlay. Initial outlay is 86 million. So no working capital in the question. We are not given working capital, so you ignore. Therefore, this is 86. This is your net cash flow. So give me net cash flow for the other years. Yes.
19.
19. Which one?
Year 1.
Okay, 19.
$38.
38.
38.
39.
39.
43.
43. Okay, so that represents our net cash flow. With this net cash flow, you can use any other technique to appraise the project. Okay, you can use any technique to appraise the project. So we want to calculate internal rate of return. Okay, so you remember, you are expected to assume 2 discount rates that will produce 2 opposing NPV. So had it been this is NPV alone, if you want to calculate NPV, I don't need to be doing it. I will just discount this one, I will get my present value, then I will get my NPV. But because this is internal rate of return, you are expected to assume 2 different discount rates. Therefore, and that's why it's important to first of all calculate the net cash flow. After the net cash flow, you can then calculate internal rate of return. So with this, I would then say calculating internal rate of return. First thing first, now, when you look at, remember, whenever you want to calculate internal rate of return, you are supposed to assume 2 discount rates that will produce 2 opposing NPV. You have to be very careful before you assume your discount rates, because the discount rate you are going to assume should be, should be consistent with the cash inflow. when you look at the size of the cash inflow relative to the cash outflow, you will notice that the cash inflow is almost double the cash outflow of 86 million. So which means that if you assume something like 10%, you are going to be having a positive NPV. If you assume 15%, because the size of the positive cash inflow of the positive cash flow is almost double the negative cash flows. So it's important for you to assume a discount rate that is kind of high, okay? So that you don't need to be doing iteration. So first thing first, we can start from, let's say we assume 15%. Let's see what 15% will give us. So assume 15%. So use this to compute our NPV. So create a column for year, then cash flow, discount factor, at, then present value. Okay, so we want to assume 15% first. All right. So year 0, year 1, 2, 3, then 4. Okay. So our NPV at 15%. So year 0, the cash outflow in year 0 is 86 million. Then in year 1, 1938. 1938, 39, then 43. Okay, those are the cash inflows. So let's find the discount factor for year 1 at 15%. Yes.
0.870.
0.870. Year 2,
0.756.
756. Year 3,
0.658.
658 or 59.
58.
58. Then year 4,
0.572.
572. So let's multiply with the cash flow. 0.87 multiplied by 19.
16.5 or
That's
17.
that's 17.
29.
29.
26.
26.
25.
25. So add it up. 51, 80. That's 97. 97 minus 86. That's 11. Am I correct? Is it 11?
Yes, 11.
So we assume 15%, we got a positive NPV of 11 million. So let's assume a higher discount rate that would produce a negative NPV. So 15 and 20%. Let's try 20% and see. So 20%. Somebody should give me discount factor at year 1 for 20%.
0.833.
0.833.
0.694.
694.
0.579.
579.
0.482.
482. So let's multiply. 0.833 multiplied by 19.
16.
16. 38 multiplied by 0.694.
26.
26. 39 multiplied by 0.579.
23.
2, 3. And the last one, 43 multiplied by
21.
0.421. So 21 plus 23, that's 44 plus 66 plus 26. That's a 70. 70 plus 16, that's 86. 86 minus, that will be 0. So that means we have found what we are looking for. Remember,
We have found the IR already.
yes. So remember, internal rate of return is the rate that equates NPV to 0. Any discount rate that you assume and produce 0 NPV, that rate is your internal rate of return. Therefore, I would then say, I don't need to, there's no need for you to go and be calculating IRR using IRR formula again. You've already found what you are looking for. So all you need to say is just that, you say, since internal rate of return is the rate that equates NPV or future cash flow to 0. Okay. Therefore, the assume discount rates of 20% is the internal rate of return. That's it. Now, this is not sufficient. Remember, in this particular question, examiner wants you to calculate the expected internal rate of return associated with the manufacture of VC4. Show all workings to the nearest million, 19 marks. You will never earn that 14 marks if you don't state your assumptions. All right. You can see how complex is this question. All those variables you are given, you ignore some, you took some. Why did you ignore them? You need to state your assumption. So you can't hand out 19 marks if you don't state all relevant assumptions. Therefore, at this stage, you need to write out all your assumption. What is the assumption you have made? All right. So you can talk about, of course, you need to talk about cash flow. You talk about cost of capital. You talk about inflation rates. You talk about the apportionments as given in the question. Okay. You talk about apportionment. You talk about any other assumption that you have made in the question. You need to talk about each of them. This is because of time. Let me just show you. Let me stop sharing this. Now, so far on this, do you have any question before I switch? Okay, so let's move on. Let me stop sharing. Let me open to Golden Book so that I'll just show you how I stated my assumption there. Let me see. Let me open this.
Thank you.
Don't share. Let me know if you can see my screen, please.
Yes, sir.
Okay. Let me show you the assumptions. Of course, assumption is not new to you. It's the same thing we have been doing so far. It's just you explaining how you have come about your numbers. Examiner will ask you, how did you tell me how you have come about your number? It's not something you're expected to fabricate. It's already in the question. Now, these are the assumptions. These are the assumptions. Okay. The first assumption, it is assumed that, of course, you talk about cash flow. So it's assumed that the cash flow estimates are realistic and will occur at the end of each year. all relevant cash flow have been inflated at the appropriate inflation rates. That's our assumption on cash flow. Then 2, we talk about apportionments. Okay, so the apportionments, the apportion of management salaries and head office charges of 10.5 million and 5 million naira per year are irrelevant and therefore ignored. That's our assumption on the apportionments. Then number 3, talk about annual interest charges. Okay, so the annual interest charges of 10.4 million naira is ignored because it's not relevant. So if you want to go further, you can say this is because the cost of capital to be used for the project already included interest. So if the absolute amount of 10.4 million naira is considered, then it will amount to double dipping. If you want to continue to, if you want to elaborate it, you can go ahead. But if you do it this way, that's fine. Then number 4, we also ignore advertising expenses of 5 million naira. Why? The advertising expenses have been ignored since no additional cost will be incurred as a result of undertaking the project. That's it. The number 5, we talk about inflation. It is assumed that the inflation rates will remain constant within the period under consideration. Okay. Then we can also talk about cost of capital. We are okay, of course. In this case, you can't talk about cost of capital because you are the one that assumed 2 discount rates to compute your internal rate of return. That's why we did not mention cost of capital here. So any other assumption that we have made in the question, we talk about them one by one. Okay, talk about it one by one. So that's that. Then in the second part of the question, examiner is also asking you in the B part, in the B part of the question, examiner is asking you what is meant by an asset beta and how it is different from an equity beta. 2 marks. We've done this under cost of capital. An asset beta measures only business risk. An asset beta is the same thing as an gear beta, which measures only business risk. Equity beta measures both business, so equity beta measures both business and financial risk, and it's always higher than the asset beta. So that's all you need to say in that one. Let me see. Where is that? Okay, this is just the working for, yeah. This is just the working for that. So this is it. Number B1, asset beta, also known as on-gear beta, measures only systematic business risk. On the flip side, equity beta measures both systematic business and financial risk, and is usually greater than the asset beta because it contains both business and financial risk. Since unsystematic risk can be diversified, the focus is generally on the systematic risk. So that's just an addition. Then number B, according to the question, number B2, number B2 of the question, examiner is asking you if you are told the company's equity beta is 1.2, the market return is 15%, and the risk-free rate of return is 8%. Discuss whether you will recommend introducing the product. 4 marks. So what the examiner wants you to do here, number 1, is to calculate a difference, to calculate cost of equity, because examiner has given you information on capping. All right, so you calculate capping. You calculate cost of equity using capping. Then you now talk about examiner is asking you to discuss whether you will recommend introducing the products. Okay, you need to talk about all the issues that surround capping. Generally, the issues surrounding cappings are just the fact that, you know, most of the assumptions, underlying assumption of capping are not realistic. So you need to negate it. Then also, the cost of equity using capping is not appropriate to evaluate this kind of a project, because where a debt is introduced, even though in the question examiner did not mention debt, apart from the fact that you are given interest rate of about 18% or 8% or thereabouts, I can't remember in the question. All right, so so you need to just talk about the inappropriateness of the cost of equity to evaluate this kind of a project. All right, then you can also talk about project risk. Okay, so those are the 3 these are some of the issues that surrounds the cost of capital or the cost of equity. So let me see how I answer that in this material. So that quickly, B2, the company's required rate of return is 16%. Of course, I've calculated the 16%. This is how I arrive at it using capping. Okay, using capping, this is it. So we got 16%. All right. Now, based on the information the examiner has given to us, so that's how I arrive at that 16%. Then I need to explain that the cost of equity, the company's required rate of return of 16%. The company's required rate of return is 16%. See calculation below, relative to the project internal rate of return of 20%. So the project appears financially viable. You know, when you want to accept a project using internal rate of return, you need to compare your calculated IRR with the company cost of capital. So the company cost of capital in this case is 16%. Okay, and the internal rate of return we computed is 20%. Therefore, of course, the project is financially viable. However, other factors may need to be considered before final decision is taken, including number one, project risk. Okay, what do you mean by project risk? Cost of capital should be consistent with the risk associated with a project. The company's equity beta of 1.2 indicate that the risk associated with the business is higher than that of the market, which is always 1. When we get to capitalized pricing model, I will explain to you how I will explain to you in details the meaning of beta value, and then the beta of of course, the beta of the market is always 1, meaning that if you calculate the beta of a project and it is greater, if the beta of the project is equal to 1, that means the project risk is the same thing as the risk of the market. But if the risk of the project is more than 1, that means the project is riskier relative to the market. If the risk of the project is less than 1, then the project is less risky as compared to the market risk. Okay, so this is what I'm trying to explain here. The beta of the company, the company's equity beta of 1.2 given in the question indicate that the risk of the business is higher than that of the market. Okay. However, it is important to note, to know the beta of the project. We are not given the beta of the project, we're only given the beta of the company. All right. The beta of the project is not available. Therefore, we cannot arrive at a reasonable conclusion on that. Okay. So that's how I discuss as per the project risk. Then you can talk about the appropriateness of the cost of capital of 20%. Okay. So the appropriate cost of capital is required to discount the expected future cash flow associated with a project for the purpose of determining its financial viability. The rate of return or cost of equity of 16% is not the same as the company overall cost of capital, that is WACC, except the company is only financed with equity. In this question, we are not told that Femi Appliances is only financed with equity. All right. Though there is no indication in the question that suggests the company has debt in its capital structure, except for the bank loan arising from the method of financing the machinery. If the company is financed with debt capital, the cost of equity will not be appropriate to evaluate the investment opportunity. All right. So that is my comment on that. And then lastly, I talk about issues surrounding capitalized pricing model. Most of the underlying assumptions of capping, including the fact that all investments are infinitely divisible and that there is homogeneity expectation by the investors, and not only that, there's no transaction cost and there's no taxes. All these are unrealistic. These are unrealistic assumptions. All right. These are some of the reasons why the model has been subjected to criticism in pricing risky assets. Risky assets are stocks. Okay, risky assets are stocks in determining the cost of capital. So these are the way I answer I complete. Without this, again, that 4 marks, examiner can just, if you don't say some of these issues, because the examiner says you should discuss it. So if you don't say some of these issues, you may not hand the entire 4 marks, maybe 1, 1.5, or 2, if you don't comment on your answers. All right, if you don't comment on those other issues. All right, so you need to watch out how to answer questions, because the examiner say you should discuss whether you will recommend introducing the products. Okay, then number C, the company is worried that government might increase corporate tax rates. Advise the director by how much that the tax rate would have to change before project is not financially viable. So in this particular instance, examiner is asking you to calculate sensitivity margin. Remember, when you did performance management, you did a topic known as risk and uncertainty. One of the techniques of hedging risk and uncertainty is sensitivity analysis. The sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. So you want to know what is the, as far as this question is concerned, the variable is on tax liability. Therefore, you want to know what is the percentage change in the tax liability that will make the project to become unviable. All right. What is the maximum tolerable level to which the project NPV can accommodate any change in tax liability? What if the tax liability increased by 5%, by 10%, by 20%? Will the project still be viable? That is what you want to determine. All right. So, but in this particular circumstance, examiner wants you to use a discount rate of 17%. Therefore, what are you supposed to do? Remember, when you want to calculate sensitivity margin, depending on the variable, sensitivity margin is equal to NPV divided by the present value of the variable. Variable in this case is tax liability. So you need to use this 17% to compute NPV first. You can't use the NPV you have computed under internal rate of return. No. Examiner wants this requirement number C is different from what you have done. So you are going to use this 17% to compute NPV. You keep it on one side. Then you now determine the present value of the tax liability. So calculate the present value of the tax liability. First thing first, the tax liability that you have computed, then you are going to less the tax saved on the capital allowance. Remember, the essence of capital allowance is to reduce your tax liability. Therefore, you find the difference between the tax liability you've computed and the capital allowance. That net amount is what you are going to discount at 17%. So you get the present value. Therefore, the NPV you have computed using 17% divided by the present value of the tax liability will give you the percentage change in tax liability that will make the project viable. That will tell you the sensitivity margin on the tax liability. Let me quickly show you that one. So this is what I'm trying to tell you. The sensitivity margin of tax liability. This should be calculated as follows. So using 17%, the NPV, using 17, you are going to pick all those net cash flow that you've calculated. The net cash flow you have calculated, you bring it out. So you use the 17% given to you to compute the NPV, and we got 5 million. So the NPV at 17% in cost of capital is 5 million. Then you now calculate the present value of the tax liability. All right, calculate the present value of the tax liability. So you pick the tax liability as you have computed previously, then you now less the capital allowance. Sorry, tax saved on capital allowance. You know, remember we have 7. So this is the net. This represents the net capital allowance. So it is this net tax liability, rather, this net tax liability that you are going to discount at 17%. And we got the total present value of 20. Add all of them together, it will give you 20. So this 20, to now get your sensitivity margin of tax liability, so it is NPV divided by the present value of the tax liability. That is 5 divided by 20. It will give you 25%, which means that tax liability should not be allowed to increase beyond 25%. So what we are saying here is that this 25% means that if you increase your tax liability by 25%, the NPV will be equal to 0, because your sensitivity margin is the rate that will make NPV equal to 0, that will make the project break even. All right, is the rate that will make the project break even. So what this is saying is that if you increase your tax liability by additionally by 25%, it means that the project NPV will be equal to 0. So the interpretation should then be that the tax liability should not be allowed to increase beyond 25%. If not, the project will become unviable. So it is only when you do this way, you solve your question this way, that's only when you are going to earn your 30 marks. All right, and whoever the examiner will be happy with you. The examiner will be happy with you. let me see if I have, let me show you the examiner's comments in this particular question. Let me show you the examiner's report. Let me see if I have it quickly. Pathfinder, hold on for me. I want to show you, for you to know what student went through in this question. Yes, I have it. 2021 November. Right. Let me stop sharing this. That's why it's showing that. Open it first. See, the examiner's comments on this particular question. Let me, which question I want, number one. Coming. Yes. Let me increase the font. Okay. Let me share my screen with you. I want to show you the examiner comment on this question. Okay. Now, this is a Pathfinder question on this. Let me quickly rush to the solution. I want to show you the examiner's comments in that particular question. So for some of you, I've been saying all this while, you can't do much in SFM without, if you can't memorize formula. Look at all the formulas given to you. Of all the formula in SFM, this is what is given to you. Formula for project specific. Then the one for modified internal rate of return, Blasco option pricing. All right. That's all. You can imagine, of all the formulas in SFM, you're only given 3 or 4. So please, you must know how to memorize formula. All right. So let me show you the examiner's report. Yes. Are we still together? Hello, guys. Are you still there?
Yes, sir.
We are here, sir.
So I want to show you the examiner report on this question. So, and I believe you can see my screen clearly. Yeah. So this is a standard investment appraisal question and is in 3 parts. Part A tests the candidate's understanding of relevant costs, investment appraisal, and inflation and taxation, and calculation of internal rate of return. Part B requires the candidate to distinguish between asset beta and equity beta. It also tests a number of practical issues concerning the appropriate cost of capital required for the appraisal of a project. Part C of the question deals with sensitivity of the tax rates. Being a compulsory question, all the candidates attempted it. Generally, the performance on this question was disappointing. Hey, can you hear that? The performance on this question was disappointing. This is difficult to understand because the scenario is straightforward and well defined in the question. Most scripts were characterized by errors in the following areas. First bullet point, a failure to omit irrelevant costs like interest, advertising, apportion cost, etc. Accurate handling of taxation and inflation, and confusion regarding arrangement of cash flows. You can see, which is normal, like I mentioned to you earlier today when we started this question, that this is purely performance management. Because if you don't have deep understanding of relevant costing for decision making, certainly you are going to struggle to solve this kind of a question. And that's why the comment of the examiner is expected. This examiner's report is expected, In part B, most of the candidates could not explain clearly the difference between asset beta and equity beta. That's very poor, okay? Because that should be an easy thing to do. In part C, majority of the candidates did not even make any attempt at all. It is recommended that students should, so that you can see the examiner's report saying that the overall performance of the students was disappointing, okay? So that is to tell you how the student find it challenging to solve the question. Please, you have to be very careful going forward. You have to expose yourself. You have to expose yourself different scenarios, all right? Different scenarios so that you'll be well grounded. You'll be well grounded wherever examiner is coming. And before you put your pen to paper, you must articulate your points. You must understand the requirement, then articulate your point, how you are going to tackle it, so that you don't rush and then just be doing it anyhow. And you're stuck in the middle of the question. Please avoid that. To help yourself, you need to expose yourself to so many practical questions and answers so that you'll be well grounded. All right. And then moving to the example with confidence eye. Okay. So yes, that's end of the question. So let's spend the remaining minutes. Let me see wherever we stop today on the other illustrations. I will just briefly complete it in our next class. You can see this is just one question since we started. We have not completed it. All right, this is just one question. So let me go back to the golden book. Let me use it to explain to you. Sure. So let's have another illustration. We can't finish it today. So by the grace of God, in our next class, we are going to complete it. This particular question was tested in one of the previous diets, but because the question involved modified internal rate of return, I would like to expose you to that as well. So this question, you have to compute project-specific cost of capital, net present value, as well as a modified internal rate of return. So let's have it. Let's have it. Okay. Yes, I need somebody to read this illustration 14 as shown in this material. Somebody should help us to read it. Yep. Who is helping us? Yeah.
Okay, sir.
Thank you, Omi.
Telemundo PLC is a company listed on the Nigerian Stock Exchange. It is involved in property development and sales. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, the decision was taken to establish a division for the production of cement in Ore, Ondo State. If the division is set up and the cement production goes ahead, output from the division will be sold to Telemundo PLC and external customers at market price. For planning purposes, it has been decided that the financial viability of the project over the next 5 years should be determined. The sum of 2 billion naira will be required. The sum of 500 million naira will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion naira will be applied for the procurement and installation of essential plant and equipment. Tax allowance can be claimed on plant and equipment at a uniform amount over 5 years with nil scrap value. The total of 20 million naira has been spent on various survey, market, technical, financial, etc. to date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payment at the end of year 1. Production of cement for the next 5 years is projected as follows. We have the years and the number of bags. Okay, a bag of cement sells currently for 2 million naira in the open market. The price is expected to increase at the rate of 5% per annum. The variable cost is now 800 naira per bag. This will increase at 4% per annum. Fixed overhead costs will be 50 million naira at current prices, but will rise by 8% per annum. Apportioned head charges of 25 million naira at current prices will rise by 10% per annum. 50% of the initial outlay of 50% of the total initial outlay of 2 billion naira is to be funded with a loan from the Federal Government Development Bank at a concessional fixed interest rate of 8%, payable at the end of year 5. The project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. The company uses a current weighted average cost of capital of 11% to appraise all capital projects. The asset beta of the company is 1.2, equity beta is 1.6, risk-free rate is 5%, while the market risk premium is 7%. The financial director is of the view that it is appropriate to use the existing work to appraise the new project. He has identified a listed company which currently produces cement and packaged food drinks. The company has the following financial statistics: equity beta 1.82, debt beta 0.40, debt/equity ratio 40%. 60% of the market value of the company is attributed to cement production, while 40% of the value is attributed to the food drinks division. The food drinks division has an equity beta of 0.8. The new project is expected to move Telemundo PLC to the target debt/equity ratio of 30%. The tax rate is 25% for the two companies and is paid in the year profit is made. You are required to A. Compute the appropriate cost of capital that Telemundo PLC should use to appraise the cement project, and state why you consider this rate more appropriate than existing WACC of 11%. Note, your final cost of capital should be rounded up to the nearest whole number. State any assumptions made. B. Compute the net present value and the modified internal rate of return of the project, assuming a cost of capital of 13%. C. Recommend whether the project should be accepted or not, using both NPV and MIRR methods.
Thank you very much, Wumi. Yes, this is another big question. In the A requirement, you have to compute appropriate cost of capital. Now, you need to ask yourself, what kind of cost of capital am I going to compute? Of course, examiner did not tell me whether I should calculate traditional work, project-specific work, or work of the combined activity. So it could be any of the three. And I told you that when a company is diversifying, or debt equity proportion are expected to change as a result of undertaking a project, of course, you calculate project-specific work. When a company is engaged on several activities, then, of course, you are supposed to calculate weighted average cost of capital of the combined activity, which is WACOCA. Then, if you are given information, and I told you, that's where we started from. If you are given information on capital structure, you are given ordinary share capital, preference share capital, debt capital, and their returns, then it means that you are supposed to use traditional method to calculate your work. Now, in this particular question, examiner has told you, in the first paragraph of the question, you are told that Telemundo PLC is a company listed on the Nigeria Stock Exchange. The company is involved in property development and sales. The object clause of this company is property development and sale. That is the primary activity of the business. Now, you are now told that a recent meeting of the board of directors at a recent meeting of the board of directors, the decision was taken to establish a division for the production of cement, which means that this company is diversifying into the production of cement. Because the company is diversifying and you have to calculate appropriate cost of capital, you need nobody to tell you that you are supposed to calculate project-specific cost of capital. However, you want to calculate the cost of capital that will be suitable to appraise cement projects. Therefore, you go to the question, you don't need to waste your time. In the first paragraph, you have identified that the company is diversifying into the production of cement. All right. So which means that you are supposed to calculate project-specific cost of capital. Then you now go to the section of the question where examiner mentioned the name of a proxy company. Once you get the proxy company information, you identify the beta of cement if given to you. In this question, the beta of cement is not given. All right, but examiner has given to you the information of the proxy. You are given a beta of 1.82. This proxy company, this listed company, which is the proxy company, the company is into production of cement. The company produces cement and packaged food drinks. So the company produces two different activities. This company is into two different activities: production of cement as well as packaged food drinks. So you are given equity beta of a company that produces two different products, that is into two different activities. In this case, this means that this 1.82 is combined equity beta. This 1.82 is meant for both cement as well as packaged food drinks. Therefore, you cannot use the 1.82 for cement. You can't use the 1.82 for cement because the 1.82 is meant for cement and also packaged food drinks. Therefore, you need to find a way of determining the equity beta of the cement. All right. So without wasting more time, what are you supposed to do to solve this question? To determine, you can see examiner has awarded you 12 marks. If you get this number A requirement correctly, it's 12 marks out of 30. Within the next 10 to 15 minutes, you are done with you pocket your 12 marks. All right. So what are you supposed to do? You don't rush it. You know, there are 5 procedures whenever you want to calculate project-specific work. 1 is to identify the proxy beta. 2, you ungear the beta if it is gear. Step 3, you re-gear. Then step 4, you calculate cost of equity using capping. Then step 5, you calculate you calculate the project-specific work. Those are the 5 procedures you are supposed to carry out. But in this particular question, examiner did not give you the beta of cement. You are given beta of both cement and the packaged food drinks, which is 1.82. So you are going to use that one. You are going to use your known variable to get the unknown variable. So something should call your mind. Since this proxy company is into production of cement and packaged food drinks, this is combined activities. Therefore, and I know for sure in the fourth procedure of calculating WACOCA is for you to estimate weighted average beta of the combined activity. You calculate weighted average beta of the combined or asset beta of the combined. So the formula you use to calculate the average beta of the combined is what you are going to use to determine the beta of the cement. Because this 1.82 is meant for both cement and packaged food drinks. That is the combined equity beta. All right. Therefore, I have to use that same formula to get my answer. So let me show you how I answered it. Forget all this story on your own. You can just go through all of that. I don't need that one for now because of time. Okay. Now, step one, the proxy beta in cement industry is not available. Proxy beta of cement is not available. However, we are given combined proxy beta of both cement and fruit drinks to be 1.82. We're also given equity beta of fruits to be 0.8. We are given market value of cement to be 60%, market value of fruit drinks to be 40%. This is information I need to calculate the beta of cement. Remember this formula. You remember this formula? I gave it to you when we did project specific, when we did WACOCA, when we calculated WACOCA. This is the same formula in step 4, okay, of WACOCA. Now, here is the combined equity beta. BEC is the beta equity of the cement multiplied by market value of cement over market value of cement and fruits drinks plus beta equity of fruits multiplied by market value of equity and debt of fruits over market value of equity and debt of cement and fruit drinks. So this is the formula you are expected to use. This is not the same formula that I can use. But since I can't just use known variable to get the unknown, but since there's a formula that you can use, why don't you use that formula? All right. but of course, you get the same answer. Move on from there. Of course, I've explained the variables already, so let's move on. From the formula above, so just put in all the relevant variables into the formula, all right? The 1.82 is for the combined equity beta. We are looking for beta equity of the cement. That's the subject of the formula. That's what we are looking for. Examiner has told us that market value of equity and debt of cement is 60%. Here is 60% market value of cement. So 60 over 100, there's no need for you to come and be saying 60 over 100. This is oversimplification. Just say 0.6 plus the beta equity of fruit is 0.8 multiplied by 40% market value of fruit. So put it in the formula. You get of course 1.83 remain, then 60% of BEC, now 0.6 BEC, then 0.8 multiplied by 0.4 will give us 0.32. You collect like terms. At the end of the day, the beta equity of cement is 2.5. Okay, beta equity of cement is 2.5. Now that I have beta equity of cement, then I can move to step 2. Step 2 says ungear the beta if it is geared. Of course, the 2.5, the beta of cement of 2.5 is geared. Why do you say it's geared? Because this proxy company is a geared company because the company has debt equity ratio of 40%. We are given debt equity ratio of the company to be 40%. Let me go back. Yes, debt equity ratio of the company is 40%. So it means that beta of 2.5 for cement is a gear beta because this proxy company is a gear company. The company has debt in its capital structure. Therefore, the 2.5 is geared. So if the 2.5 is geared, we need to ungear it. How am I going to ungear it? I will then go back to the question. Am I given debt beta, or debt beta is assumed to be risk-free? Examiner has given us debt beta of 40%. Okay, I will say the equity beta of 2.5. Let's follow through the solution. The equity beta of 2.5 is geared because the proxy company has debt in its capital structure. Therefore, we need to remove the financial risk using the debt equity proportion of the proxy. Also, since we are provided with the debt beta of 0.4 for the proxy, the following formula will be used. So you use that bit for nothing formula. All right, use the bit for nothing formula. All right, so put in all the relevant variables. At the end of the day, the beta asset is 1.8. Okay, the beta asset is 1.8. Now, remember, this is a note I gave to you in this solution. Since the examiner is not specific on the gearing ratio, at times examiner will tell you how your gearing ratio should be. Examiner can tell you that as a result, the gearing ratio should be debt over debt plus equity. In that case, that means examiner wants you to use total. But where examiner is silent, you are at liberty to calculate your gearing the way you like, the way you want, or the way that is more convenient for you. Then what is important is that you just have to state your assumption. All right, you just have to state your assumption. So in this question, the examiner did not tell us the gearing ratio. So you are at liberty to either use 40 to 60 or 40 to 100. So whichever one you use is what the examiner will mark for you. Okay, so that is for that. Then step 3, you want to re-gear to incorporate financial risk of Telemundo. In this case, you need the information of the main company, not of the proxy company again. Remember, so since we are not given the debt beta, now at this step 3, if you are not given the debt beta of the main company, which is Telemundo, you can either assume the debt beta of the proxy company, or you assume that debt beta is risk-free. So whichever one you do, just state your assumption. That's what the examiner wants from you. So if I can decide to assume that debt beta is risk-free, since I'm not given the debt beta of the main company, which is Telemundo. So I can decide to say debt beta is risk-free. But in this solution, I assume the debt beta of the proxy company, which is 40%, 0.4, and that's what I use. So in this case, we are going to repeat the same formula you use in step 2. All right, but the information, the variables that you are going to use will be different because you are using the information of the main company, which is Telemundo in this case. All right, so the debt equity ratio of Telemundo is 30%, which means that debt is 30, equity is 70. All right, So we're assuming the debt beta of the proxy company to be 0.4. So put it in the formula, we got 2.24. So if my assumption is that since I'm not given the debt beta of Telemundo, then I can assume that that means I assume that debt beta is risk-free. So if I assume that debt beta to be risk-free for Telemundo, in this case, if I want to regear, I would just say beta equity of a gear equal to beta assets multiplied by 1 plus 1 minus tax, debt equity proportion of Telemundo, which is the main company. So beta equity of a gear will then be equal to beta assets. The beta assets, I think we got 2.2. What did we get? 1.8. Beta asset is 1.8. Then, of course, multiply by 1 plus 1 minus tax. Examiner gave us tax rate of, I think, 25%. Yes, tax rate of 25% for both companies. So that will be 0.75. So if you are given tax rate of 25%, you are supposed to account for 75%. So debt equity proportion of Telemundo is 30%. That means debt is 30, equity is 70. So with this, I would then say 30 over 70. Okay. 30 divided by 70. Oh, sorry. Error. 30 divided by 70. What's wrong with you? 70 equal. Okay. Then multiply by 0.75. 0.75 equal plus 1 equal multiply by 1.8 equal, that's 2.8. Is it 2.8? Let me recalculate it. Pardon?
2.38.
2.3. I don't know why my calculator is showing 2. I think I pressed something else. So 2.38. So beta equity of a gear would then be equal to 2.38. So if I assume that since I'm not given the debt beta of Telemundo, which is the main company, and I assume that debt beta is free, since I'm not given that, it means that debt beta is risk-free. So I'm going to calculate, this is where I'm going to calculate the beta equity of a gear, which is 2.38. But if I assume the beta of the proxy company, for Telemundo, then beta equity of a gear is 2.24. So you are at a liberty. It says you are not given. So if you are faced with this kind of a question tomorrow, you are at a liberty to choose whichever one that is more convenient for you. This guy is faster. Okay. This guy is faster. Just use it and move on. Since you are not given, then you don't need to be stressing yourself and be using the bigger formula. So just use this one and move on. All right. So that is step 3. Then step 4, you calculate cost of equity using capping. How do you do that? I'll go to the question. I go and identify the risk-free rate of return. What is the risk-free rate of return according to the question? We are told that the risk-free rate of return for the main company, here is it. The risk-free rate is 5%. Then the risk premium is 7%. Okay. Risk-free rate of return is 5%. Risk premium is 7%. So that's what you are going to put there. Okay. Yes, this is the risk-free rates. Then this is the risk premium. Risk premium is different between market return and the risk-free rate of return. So the difference between market return and risk-free rate of return is the risk premium, which is 7. So using this, it is 20.68. So if I assume that debt beta is risk-free for Telemundo, and then to calculate my capping, I'll just say cost of equity equal to 5 plus the beta of 2.38, beta of 2.38 multiplied by risk premium of 7. I will get my answer. So this will then be equal to 7 multiplied by 2.38 equal plus 5.
21.65.
That's 21.66. Okay. 21.66%. So if I assume that debt beta is risk-free for Telemundo, my cost of equity would be 21.66. If I assume the debt beta of the proxy company for Telemundo, my cost of equity will be equal to 20.66. Don't go and be demonstrating the two on the day of the exam. Whichever one you do is what the examiner will mark for you. But what I'm now saying is that since you are not given the debt beta of the main company, just assume that it is risk-free. So you don't need to be assuming the beta of the beta of a proxy company. Just move on. Then step 5 says you should calculate project-specific WACC. Put it in the formula for WACC. We got 16%, approximately 16%. So if I'm following this route, okay, in that case, my WACC will then be equal to my cost of equity is 21. My cost of equity is 21. Debt equity proportion is 30%. So debt is 30%, equity is 70%. So I would say 0.7 multiplied by 21.66%. I'll keep it on one side plus the other side, which is debt side. Then, of course, this debt is 30% multiplied by cost of debt. How do I get the cost of debt? I will then go back to the question. How do I determine my cost of debt, cost of borrowing? Examiner mentioned in the question that fixed overhead costs. No, that's not the information. Yes, you are told that 50% of the total initial outlay of 2 billion is to be funded with a loan from the federal government development bank at a concessional fixed interest rate of 8%. So the cost of debt is 8%. So that's your interest rate. That's your coupon rate. Therefore, when I'm calculating my WACC, my KD is 8%. My KD is 8%. That's how you got it. That's how you see the 8% you are seeing there. That's how I got it. So I would then say 8% multiplied by after-tax cost of debt. Okay, tax rate is 25%. You are supposed to account for 75%, which is the same thing as 0.75. Okay, the same thing as 0.75. So if that is the case, I will just come from the left. I will say 0.7 multiplied by 21.66 equal to 15.16. So WACC equal to 16. Is this 66? Let me confirm again. 51.16 rather. 15.16% plus the other side. Plus the other side, which is 0.3 multiplied by 8 multiplied by 0.75 equal 1.8. 1.8%. So when you add the two together, the WACC will then be equal to 1.8 plus 15.16. That's 16.96. 16.96%. Approximately, examiner says you approximate your answer. So this is approximately 17%. Okay, this is approximately 17%. So if I assume that debt beta is risk-free, all right? So this is, I'm going to get 17% WACC. If I assume that the debt beta of the proxy company, then the WACC will be equal to 16%. You can see. So whichever way you want to go about it, you are good to go. What is important is that you have to state all relevant assumptions. All right. So examiner is also asking us to state the assumption on the calculation of the cost of capital. So I talk about business risk. I talk about debt equity ratio. Then you can also talk about number 3. You can also talk about debt equity proportion. Okay. If we have assumed, of course, talk about debt equity. Debt beta. Talk about debt beta. Okay. Talk about debt beta. All right. What do you mean by business risk? Business risk is the risk associated with the industry in which a company operates. It is assumed that the proxy company has the same systematic business risk with the Telemundo PLC. That's my assumption on that. Then number 2, talk about equity ratio, debt equity ratio. The debt equity proportion used for ungearing and regearing of betas of both proxy company and Telemundo PLC are as follows. The proxy company, I use 40% for debt, 60% for equity. Then for Telemundo, I use 30% for debt, 70% for equity. That's my assumption on that. Then under debt beta, so you can say there are two ways you can do this. If you assume the debt beta of the proxy company, then you can say the debt beta of the proxy company of 0.4 is assumed for Telemundo. If you assume that debt beta, since debt beta is not given to you, you can say, since debt beta is not given to you, it is assumed that debt beta is risk-free. All right. So that's the way you can state your assumption. That's the way to state your assumption. All right. And that's end of number A, requirement. I don't want to rush you. So let's stop it in our next class. By the grace of God, we are going to solve the B part of the question. All right. We solve the B part of the question. Then you can go ahead to practice illustration. There are so many illustrations. I think you have this particular question in your material, in your class notes, which is the question that was tested in 2017 or thereabouts. Let me even see. The one of a Ferrari. Okay, that question on Ferrari. Let me see. So you can go and practice it on your own. That question also involved project specific cost of capital. All right. So go and practice it on your own. I think this is it. No, this is Mississippi. Yeah. Let me see. I just want to, so that you get exposed to different kinds of scenarios. Your confidence will be so high on that day of your exam if you have practiced, because there's no two way about it. It's all about practicing. Just continue to practice different kinds of, any question you can lay your hands on, continue to practice them, because you never can tell. The more questions that you solve, the better for you to really boost your confidence. Where is this question now? This is it. So go and practice the question on Ferrari. Okay. In the question 2, you have to calculate, this one was even more direct. You have to calculate project-specific cost of capital. All right. So number B, you are expected to appraise the project. Examiner did not tell you the method, but you need nobody to tell you that you are supposed to use MPV to appraise the project. Then step number 3, or number C, you have to state all relevant assumptions. Is a given. So go and practice this question on Ferrari. Go and practice it. It's also a very interesting topic, question. Go and practice it on your own. So this is where we are going to call it a day. By the grace of God, we are going to continue next time. All right. So when we shall be completed, I thought we'll be able to complete it today, but we spent so much time on the first illustration. Okay.
This material, which page is that?
Take it again. I didn't get you.
The page of the material, which page is that?
You mean this question on Ferrari?
Yes.
It's illustration number, I think illustration number 5 or 6 in the class material you have with you. Okay. Yeah. So that's end of the question for end of today's class. So in our next class, by the grace of God, we continue from where we stopped. All right. Let me know if you have any question for me before we call it a day. Any question? All right.
Please, sir.
So yes.
The first question we solved this evening.
Yes.
Is it practically possible for one to solve that question under 1 hour under examination condition?
It is possible. Seriously, it is possible. And that's what I'm emphasizing on. Practice, just continue to practice, because the more you practice questions and answers, the better for you. It will really help you. It will boost your morale. All right. It will boost your morale. Now, this is the approach. You know, it's a compulsory question, right? What you need to do is that you scan through all the 7 questions that will be given to you on that day. First thing first, go for those questions, the simplest ones, the ones you can solve within 15 minutes, 20 minutes. If you can have pockets of about in section B, where you have 20 marks question, if you can solve like 2 of that, or you solve 2 of that in the section B, or maybe 1 or 2 more in section C. So that's 4 illustrations, that's 4 questions. You pocket it, then you can spend like maybe 1.5 hours for section B and C. Then the remaining hours, the remaining 1.5 hours, come and waste it. Come and spend it on the compulsory question, because compulsory question is 30 marks. So, and you need to maximize it. You need to maximize it. So your focus should be that you must be targeting between 20, 25, and 30. That should be your target. And that's what I'm saying, that when you are solving compulsory question, you don't rush. You must first of all understand the requirements. After you have digested the requirements of the question, then you now articulate your points, how you are going to answer the question. All right? Because once you rush it, you just be canceling your answer. You cancel, you write again. And the more you do that, you are just wasting time. So it's better for you to digest, understand it before you begin to solve. So fine, of course, it's a fact. Within 1 hour, you can complete this question. You can see that when we finish solving, when we finish doing the workings in the question, when we finish the workings, it was easy, it was faster for us to solve for internal rate of return. So the major work is on that workings. So once we finish it, all you need to do is to just be posting it, to be posting all the workings that you have done. So within 5 minutes, you've already posted what you need to post. Then you now move to requirement B and C. All right. So it's doable. It's achievable within 1 hour. You can complete it. But again, remember, we're in a class. On that day, you'll be in the exam hall. The pressure will be very high. You are working under so much anxiety. And that's what I'm advising students, that always go for the cheapest question first. You don't start with the compulsory, because once you start with the compulsory, you may spend 2 hours plus. You won't know. You will not know that time has gone. Because if you make a mistake, you have to start all over again, and your mind will just be there until until invigilator tells you that, oh, 30 minutes more, and you now begin, you become to be getting agitating. What am I going to do now? Just be doing it anyhow going forward. So you need to avoid that. So go for the cheapest question first. Once you have solved 3 or 4 of the easiest one, then of course, then go and waste your time on the compulsory. Spend the remaining hours on the compulsory question. Strategize how you are going to maximize your score. That's the way to go. That's just the way to go. That's the way to go. All right. So yes. Any other question for me so that we can close the class for today? Okay.
Sir, please, sorry, this kit you are using, it's as if I don't have it. So
Which one?
this material kit you are using, because the one I have, I'm not seeing the question that we just solved now.
Is there? Okay, you mean the one of Telemundo?
Yes, sir. Yes, sir.
No, Telemundo is not there. I will share with you. I will share the question with Telemundo is not there. I will share with you. All right. I will share the question with you so that we'll be on the same page. Okay.
Okay,
So
sir. Thank you.
you're welcome. So that's that from me to you. I will see you next time by the grace of God. Bye-bye, everyone.